Behind the Ticker is brought to you by UX Wealth Partners. If you're a TAMP user and you're sick and tired of the legacy technology they are run on and you want more customization and flexibility, as well as a AI-driven model marketplace, UX Wealth Partners is your destination. On top of that, they have institutional trading. So if you are an ETF issuer or an SMA provider looking for outsourced institutional trading, UX Wealth can also be your destination. So check out uxwp.com to find out all the ways UX Wealth Partners can help grow and make your practice more efficient. Welcome to Behind the Ticker. Today we have on David Dziekanski. He is from Quantify Funds, and we are talking about their stacked Bitcoin and gold ETF, ticker BTGD. And I'm glad we had him on. This is our last episode of 2024. We are going to take a winter break, but I thought this episode is extremely timely with everything going on in the Bitcoin space. And so David and I talk a lot about that. We also talk about this innovative stacked product that for every dollar you put in, a dollar goes to Bitcoin and a dollar goes to gold, and it will automatically rebalance to keep that 50-50 split. So again, a very cool and innovative product. I think it fits well in your portfolio as, you know, a hedging mechanism or as that like alt bucket, if you will. So without further ado, please welcome Mr. David Dziekanski. Hey, David, welcome to the show.
Thanks so much for having me, Brad.
So before we get started, why don't you give everybody a bit about your background and how you ended up here at Quantify Funds?
Absolutely. So my name is David Dziekanski. I'm the founder and CEO of Quantify Funds. I've been in the investment and ETF world for, about 17 years. The last 11 years, I was a partner and portfolio manager at Tidal Financial Group, a platform to help institutional managers bring ETFs to the marketplace. Took the jump and moved over to the client side, and I'm now partnering with both Tidal and another client of Tidal's, the Return Stacked ETF folks, to bring you this stacked lineup we have here, with our first offering being the STKD Bitcoin and Gold ETF, ticker BTGD.
Yeah, and we're going to get into the ETF for sure. Before we do that, though, I always like to ask, any hobbies? What do you like doing when you're not working?
Gosh, I love hiking in the mountains, escaping to beaches. I'm a born and raised New Yorker, so I like doing the exact opposite of everything you can find in New York City. Find a beach without a person for a mile or the middle of a mountaintop is heaven for me. So,
yeah, I think I'd take a beach right about now. It's snowing already, and I'm not ready for it.
Yeah, New York has not really felt the true effects of winter yet, but I'm sure it is coming.
Yeah, I was just there a couple weeks ago, and you can. It's always worse when you turn down the one street that's just an absolute wind tunnel, and it's just brutal. You can't get out of it.
Yeah, winter's no fun in cities. You get the wind tunnels, you get the dirty snow, you don't get to the glistening white effects of the snow everywhere. It's no fun to be in the city during this time.
So let's get straight into the ETF. I mean, this is a really interesting product. I'm glad we were able to connect. I think it's timely, right? With everything going on, Bitcoin breaking 100,000. So the ETF, as you had mentioned, is BTGD, which is the STKD Bitcoin and Gold ETF. So first, give me a high level of what this fund is and really what it's trying to accomplish.
Absolutely. So STKD is short for stacked. This is a stacked ETF. We stack two different assets on top of each other. In this case, we are stacking Bitcoin on top of gold. So for every dollar you put in the ETF, you get a $1 exposure to Bitcoin and a $1 exposure to gold. Alternatively, you can also think of it as a portfolio that is a 50-50 mix of Bitcoin and gold times 2. So this is a new way to do leverage ETFs where we're not just leveraging the same asset on top of itself, which allows for what we like to call leverage for the long run, leverage with less path dependency and potential for decay, leverage that can be structurally implemented into your model portfolios.
So let's talk about how you kind of manufacture the product on the back end. So what type of investments are you using really to drive or derive your underlying exposure? I'm assuming you're using futures as well as some other things.
Yeah, currently we're using futures and the exchange traded products in both the Bitcoin and gold space. We use the futures to get the most optimal form of leverage on these two asset classes. And then we use the ETFs to allow us to have a cost-effective way to rebalance on drift between the two allocations of Bitcoin and gold, so we can stay on target to that 1-to-1 ratio between the two assets.
So let's talk about that, like, rebalance schedule. Are you bringing this portfolio back to for any drift on a daily basis? I'm assuming with the volatility that Bitcoin brings, you're going to have to be kind of pulling these back in line, fairly often.
Yeah, so this is an actively managed portfolio, so we have no specific mandate on that. We are targeting about a 5 to 7% rebalance drift, and we'll oftentimes rebalance more frequently with creates. But it's a game of rebalancing versus trading costs and minimizing the drag that overtrading a portfolio could have. So we very much like that 5 to 7% range, which ends up resulting in usually about a trade, maybe a trade and a half a week.
Got it. So let's talk about like the overall rationale, right? Like, what is the rationale behind combining Bitcoin and gold within a single investment vehicle?
Yeah, it's so funny. Some people struggle to see the connection, and some people see it instantaneously. And we've found actually the lack of correlation between the two assets sometimes makes it difficult for people to conceptualize them as a similar concept. The concept here is these are two assets that are deemed scarcity assets. Gold has been a store value for as long as history has been around. Bitcoin in its simplest form is digital gold. These are two assets that mine at a rate that is much smaller than the rate at which paper currencies print. Developed nations print about 7 to 9% of currencies in circulation each year. Bitcoin mines at about 0.86% a year, whereas gold mines at about 1.75% a year. So in its simplest form, at what pace will developed markets around the world print their currency? And the bet is that it's going to be over that 2% mark. And these will continue to be scarcity assets that should appreciate as global currencies depreciate. So this is what we'd like to think of as almost a 2-for-1 prepackaged currency debasement hedge in one.
Got it. I mean, it makes total sense to me. So, like, in your experience in kind of following these two assets over time, how does the volatility of Bitcoin and then gold's relative stability interact within this portfolio?
Historically, Bitcoin is about 3 times as volatile as gold. What we find most intriguing in this pair is the correlation tends to range from as high as just over 50% to lower than minus 20%. And it is the swings in that is most interesting, that allows for rebalancing between these two assets. I always ask, I think there's actually a lot of people that allocate to both Bitcoin and gold in their portfolio already. But I always ask them, in the last 2 months, have you trimmed Bitcoin at all for gold? And doing that difficult trade is oftentimes easier said in practice than it is to actually implement in reality. In terms of historical data, if you look at the last 2 big crypto winters, gold held up exceptionally well in both of them. The first crypto winter, gold was down a little less than 2%. The second crypto winter, gold was down in the mid-4s. But most beneficial was that gold was actually up in the first half of both of those crypto winters. So the rebalancing mechanism of staying close to target of a 1-to-1 ratio between the two always allowed you to harvest something from the gold side to allocate further to the Bitcoin. If you did a back test of Bitcoin and gold futures minus the cost of financing, you'll see that the drawdown during both crypto winters was not so significantly greater than just Bitcoin alone. It was 1 to 2% larger. And that's really just because of the diversification benefits that gold portrayed during those 2 significant volatile environments in the crypto space. And we have no reason to believe that wouldn't exist again in future crypto winters. I think what you've seen post-election is almost proving that out in real time. The correlation between Bitcoin and gold is absolutely plummeting. Bitcoin is trading a lot more like risk assets. Gold is trading a lot more like fixed income, treasury bonds. Both assets or both sides of the table are really moving in response to what they think inflation will be with the new administration, with tariffs and things of that sorts. But we like to think of it as, if one of them is more scarce equities and one of them is a more scarce fixed income, this is our preferred 60-40 vehicle of choice versus traditional stocks and bonds.
Yeah. And, I have advisors ask me all the time. They're like, what is, or discussions around, Bitcoin's correlation. And it's funny. It was like not correlated to anything. Then it got pretty correlated to, tech or large cap growth. And, I just think over time, Bitcoin just really beats to its own drum. I think we're trying to figure out an appropriate correlation number to, equities, to gold, to treasuries. And I just don't think Bitcoin cares about any of it. Is that a fair viewpoint?
Yeah, correlation versus causation. If you looked at what Bitcoin did during the Silicon Valley Bank fiasco, it was performing much more like a scarcity asset. And I think the real bet is not necessarily what it is correlated to today, but what it will trend towards correlation-wise in the future. And we believe that's going to be more and more in the camp of scarcity assets, especially if we ever get into another cycle where we're going to have to unleash the quantitative easing back onto the market cycle. That's when you're really going to see this thesis take off, because just the mismatch between supply is going to skyrocket. And truthfully, I think a lot of this is due to the fact that most Americans, until the last 5 years, had no idea what inflation really felt like, or very few of them, very few participating members of the economy still remembered what inflation felt like. So I think the idea of what is the government doing with our dollars, how much are they printing, how are they using it, is much more top of mind, because we all feel inflation, at least in the US, for the first time in a long time.
Yeah. So simple question, but it's the more I thought about it, the harder it is to answer. Is like, if I'm an investor measuring the performance of this ETF, like, what is your benchmark? Are you just blending and creating a benchmark, or are you benchmarking yourself against Bitcoin? But that would be unfair. Like, how do you look at kind of evaluating the performance of this ETF against the benchmark?
Yeah, you do have to look at each counterpiece individually and then subtract the cost of financing between the two. So unfortunately, the best benchmark is both Bitcoin and gold minus the cost of financing, which is very cost effective in today's markets through futures. But I think you could also just benchmark this specifically against Bitcoin, especially because gold is so much less volatile than Bitcoin. So in that instance, gold just really needs to outperform the cost of financing to warrant the leverage on top of Bitcoin to allocate to as well. But we also think this is something that people have in their portfolios as individual assets as well. And yes, the whole advisory space is going to need to catch up on performance tools and comparison tools to start incorporating some of these new stacked products. These, we think, are really some of the first tools that are really acceptable in advisor models. These, unlike the daily use leverage ETFs, don't come with warnings of daily use. They should be much less of a compliance nightmare in advisors' models. But the second you have an advisor who, through underlying ETFs, starts managing a portfolio that has 110% overall exposure, it's unfortunately not just our security, but the whole book on a performance basis that becomes a little bit trickier to benchmark.
Got it. So, oftentimes people look at gold as a potential hedge in their portfolio. Do you think this ETF could kind of fit into that same category as an overall hedge, or like, how do you view it in terms of where this would kind of fit in and how advisors should be talking about it?
Yeah, this is a debasement hedge. Gold could be an alternative to fixed income. Gold, as we alluded to, is very correlated to fixed income and is much more scarce than treasury bonds. They print much more treasury bonds than they do gold. But long term, we view both these assets as a protective asset. Even though Bitcoin and, in this case, until recent, gold have both risen alongside the rise of the US dollar this year and in past years, so many allocators have trended so far towards just a US only equity portfolio that they're actually so dependent on the strength of the US dollar that we think if there's like one hedge to hedge your primarily US equity portfolio against a declining dollar, which could happen for a number of reasons, we actually think this is an ideal vehicle to mix both Bitcoin and gold in one to hedge against that drawdown potential in the US dollar.
Got it. So how do you, I read today, BlackRock had kind of come out with their 1% to 2% allocation recommendation for Bitcoin across a well-diversified model portfolio. But given that this has gold exposure, I think in your mind, you probably could get away with a little bit more overall exposure in a portfolio. So like, how do you talk about allocation percentage in, an already well-diversified portfolio? Are you looking at, 5%, maybe up to 10% allocation? Like, where do you see this fitting and how?
I mean, we think anywhere from like a 2 to 5% allocation in Bitcoin and gold makes sense and can protect a portfolio. I saw that article that you're referencing that BlackRock alluded to, a recommendation band of 1 to 2% in Bitcoin. I don't know if you want to take a friendly wager. Maybe we can redo this podcast in 12 months. Like, how much do you want to bet that range is higher next year going into 2026?
I would agree with that.
So this feels like the first step into that range. I mean, first and foremost, speak to your financial advisor before making any of these decisions at all whatsoever. But I do think, anywhere under a 5 to 7% allocation is warranted. And some people go much higher than that as well. But that really allows you to get some protection against volatility that could come from other parts of your market if the driving force of a downturn is the strength of the US dollar.
And the other thing with this too is, you have advisors like to have the bucket conversation, right? We've all heard it. Where are you kind of bucketing this product? Are you kind of putting it in that other, where do you like to try when you're talking to advisors to kind of have them place this in that overall diversified model portfolio?
I think for some allocators, this is an alternative investment. Some look at it within almost like an alternative commodity sleeve, or as you referenced, an other sleeve. The thesis here is the currency debasement thing. What we've seen in the ETF landscape, especially being with a platform such as Tidal for so long, that while there is a huge adoption in the alt space, advisors don't like alts that don't move. Your alt needs to have some volatility. And the reason is nobody wants to put 15% into an alternative that may or may not work without any real rhyme or reason other than, well, the black box didn't work this year, right? There's no economic rationale to explain why a managed futures or a long short might have performed that a client can fully understand. And so what's worked in adoption is higher volatility alternatives that can still move the needle in your portfolio in a smaller allocation. And that's what we're doing here. This doesn't need to be 15% of your portfolio to really have an impact on your portfolio. This is a high vol alternative. The thesis here is currency debasement against the US dollar or alt currencies. Does that make sense?
Yeah, makes a ton of sense. And the other thing I wanted to kind of pick your brain on too, and is, Bitcoin in my, since me being in the industry, is the first real asset class that it seems like the retail channel has more education and understanding around than their advisor, right? They are generally taking this idea, at least over the last handful of years, taking this idea to the advisor and saying, how do I get exposure to this? And can you get me exposure to this? So the name of the game here really for, people like you, as well as some of the others that have come out with Bitcoin or crypto ETFs, is that advisor education. So how are you approaching when you're sitting down with an advisor and making the case for BTGD? Like, how are you helping them understand Bitcoin better? How are you viewing education? Like, overall, how are you approaching advisors with not only this product, but with the overall idea that this is a necessary investment to have in their portfolio?
Yeah, we tried to focus on the education of what is stacked, how do we achieve this stacked, and that's what. In truth, I don't actually think the advisors need as much education in the Bitcoin space as people think. I do think there's a lot more knowledge in the retail space than some people give credit for. But I think we've been in a political environment where advisors and broker-dealers have been handcuffed and terrified away from getting anywhere close to making a recommendation to a client on a fiduciary basis to allocate to Bitcoin. That I think obviously there's going to be some education for the masses. But I think it's really been lack of clarity of what they're allowed to do or not allowed to do that has really caused most of these institutions to tell their financial advisors to stay away. But we're not in that world anymore. We have the most Bitcoin-friendly government that we could have potentially had. Larry Fink, the CEO of the largest asset manager in the world, just recommended a 1 to 2% allocation sleeve in this across your entire model allocation. I don't believe that was meant just for an aggressive growth portfolio. I think that's actually the most alarming, not alarming, but interesting thing of that statement is this is not just a growth asset. This is a protection asset. They didn't say put this in your Roth IRA. They said 1 to 2% across the board. So I think advisors have more knowledge than they're able to lead on, because they're not allowed to really voice that opinion or that knowledge to the marketplace or specifically to their clients. But, in an environment where we have a very crypto-friendly president, a crypto czar, and Larry Fink is recommending a 1 to 2% allocation in Bitcoin, at some point, an advisor is going to look at himself in the mirror, or the clients are going to just question him and say, are you really sure you want to bet your career on this not being helpful as a 1% allocation in your portfolio? And I think we're going to start seeing the cascading effects of that occur over the coming months, 5, 6, 7 months.
Yeah, your timing here is definitely, very good. I agree with all the things you just mentioned there. This is a fairly new ETF. I'm not sure when did you launch exactly? Sorry.
We launched on October 16th.
Got it. So again, fairly new. You've been in the ETF space, working with Tidal, so you understand, the business. With any new ETF, right? The name of the game is distribution. And so how are you guys, viewing internally, distributing the product? How are you going to try to raise as much assets as you possibly can in this thing over the next 12 and 24 months?
Yeah, we started off with some really amazing Twitter spaces. Our day of launch, we had Peter Lynch and Lynn Alden discussing and arguing Bitcoin versus gold. We plan on producing a lot more video and research content to distribute to the advisor community. Outside of that, just more traditional blocking and tackling online advertising, which we have just started to kick off in the last week or so. You'd be surprised how much of this world is really just like seeing an ad a couple times and then letting it be dispersed amongst the message boards, whether that be within an RAA or Discord or WhatsApp group. So much of this world moves on these small little chats, whether it's in Reddit or Webull posts, etc. So just getting onto all these little platforms and building awareness is stage one, and building a database of resources for advisors to fully understand our product once they find us on our website.
Well, I think it's a cool product. I really do. And I like the idea of continually keeping these things in line. At 50-50, it makes a ton of sense to me. And so you mentioned your website. Before I let you go, David, I need to ask, where can people learn more about BTGD and, your firm as a whole?
Yeah. And again, Brad, thank you so much for having us on. We are Quantify Funds. You can find more information at quantifyfunds.com or Quantify Funds on Twitter, soon to be Quantify Funds on YouTube as well. We have a LinkedIn channel as well. So we're going to be producing a lot more content on that side. Brad, it's been a pleasure, and thank you so much for having us on.
Yeah, David, thanks for spending some time with me.
Have a great afternoon.